do think a September rate cut is a done deal. Essentially, what's happened is as the Fed has left its interest rate unchanged in the mid 5% region, well, inflation has declined. The real interest rate, the interest rate above inflation, has actually been rising. And that's tightening policy in an environment where perhaps the Federal Reserve won't want to do that. So if we do see interest rate cuts starting in September, I think we could see as many as 3 interest rate cuts this year, one at each of the last 3 meetings. That would just be the Fed normalizing its policy, or essentially bringing the real interest rate down to where it was, for example, at the start of this year or even midway through last year. Another interesting thing that's happened is heading into this year, traders and economists had predicted up to 6 interest rate cuts from the Fed. Of course, we're not going to get that now. But instead of canceling those interest rates, traders have instead just pushed them back. And now many of those interest rate cuts are expected in 2025. So my best guess at this point is that we could see as many as 3, at least 2 interest rate cuts this year, and then another 3 or 4 as we move through next year. And again, that would just be the Fed normalizing policy, assuming the economy remains on track, rather than emergency interest rate cuts that reflect imminent fear of a recession. Think about where we are. We're at 5.5% interest rates here in the U.S. So that could be 10 interest rate cuts to get down to 3%. If that is indeed the new normal, we'll see. But there's a lot of room there to sort of normalize gradually over time and in a controlled manner that I think makes it different than some of those past environments. Overall, I see the U.S. economic momentum and resilience as fairly strong. Across the entire year, the IMF just came out with its economic forecast last week and projected 2.6% growth this year, 1.9% next year. So overall, maybe a slight slowdown from the strong growth we had seen previously, but not the type of environment where the experts who are focused on projecting economic growth are suggesting we'll see an imminent recession or big slowdown. As far as how the Fed's rate cuts play into there, overall, I think rate cuts impact the economy fairly minimally and with a lag, so I wouldn't expect any immediate impact on the underlying economy. The key area to watch, though, will be in the housing sector. Of course, here in the U.S., everyone has 30-year mortgages, and that's actually led to a freezing of the entire housing market as homeowners have locked in interest rates and mortgages at around 3% are very loath to move somewhere and pay a 7% mortgage. So I think that could be the key area to watch. If the Fed starts to normalize its rate, perhaps that unfreezes the housing market, a key portion of the U.S. economy, and hopefully can get that market flowing again. And that is the primary way I see interest rate cuts impacting the U.S. economy. Home builders were burned so dramatically in the great financial crisis that they're only very slowly trickling new supply onto the market. So we have an environment where there's relatively little new supply. None of the existing supply is really coming on the market. And it's a really tough situation, frankly, for people who aren't currently homeowners and can't find a way to get onto that cycle. I do think so. Oftentimes, you may have heard of people talking about the poor breadth, or essentially that only a couple of big stocks, most of them technology stocks, have been what's driving indices higher. That's led to outperformance in the NASDAQ relative to other indices. But what's interesting is many people say that with a bearish bent, that if those big tech stocks like NVIDIA finally take a breather and come back, that means the stock market could fall. And that's certainly one way to resolve that divergence. But the other way is that some of those small mid-cap stocks actually catch up. And we do see some signs, some macroeconomic factors that could support continued gains in small caps, like the aforementioned potential for interest rate cuts. That tends to help the main street smaller businesses more than some of the larger tech companies that, frankly, can get funding regardless and have massive cash piles. So I do think eventually we'll start to see this rally broaden out, see those other indices eventually start to outperform the NASDAQ 100. I'm not quite sure we're there yet, just because the AI infrastructure investment cycle still seems to be going full steam ahead. But if we start to see some signs, either this earnings season or over the next couple, that some of those big tech companies are pulling back, that could be sort of the needle that pricks the bubble in AI. And that's where we could start to see some of those other indices pick up the baton and outperform the NASDAQ 100. It really does come down to growth. And you're right to name Apple and Tesla are the two that are sort of not growing, or at least not growing strongly in the current environment. Despite that, they still have valuations on par with some of the other big Magnificent Seven stocks. So I do think that the downside risk is perhaps highest in Tesla and in Apple. Because of that slower growth, especially as Tesla tries to scale up its EV business, encountering a lot of difficulties, and it's just more difficult in the physical space to scale up than it is in the digital space. Obviously, NVIDIA remains sort of the hub of the AI flywheel. So as long as that theme continues, I think NVIDIA is well positioned, despite its very high valuation. At some point, it will come back. But right now, I'm not seeing any signs of slowing there. So I think that could be well positioned. And the one I'm most interested in this earnings season and for the rest of the year is actually Amazon. Amazon, if you compare it to the other Magnificent Seven stocks, has between 8 and 50 times more employees. It has 1.5 million employees versus closer to 20,000 at NVIDIA, closer to 200,000 at Microsoft, and the rest of the Meg 7 stocks are in between that range. So to me, that represents a big opportunity with the potential for AI and robotics and automation to produce efficiencies to reduce that headcount at Amazon, still maintain the same level of productivity, and therefore that could just flow straight down to the bottom line and benefit that stock. Also, Amazon is essentially unchanged over the last 3 years, which is a sharp contrast to the big rallies we've seen in names like NVIDIA. So I think there's potential for Amazon to catch up if indeed this AI hype cycle has anything to it. At the end of the day, Amazon could be the primary beneficiary. I do see that 20,000 level as the key technical level to watch when it comes to the NASDAQ 100. As you alluded to, the NASDAQ broke a bullish trend line dating back to April last week. So that it comes down to timeframes, doesn't it? So it broke a short-term trend line. Doesn't mean we're immediately going to go from an uptrend to a downtrend. We might instead go to just a sideways trend. And certainly if you take a step back with some of those long-term moving averages trending higher and frankly just crossing your eyes and showing it to my 5-year-old daughter, she could tell you the chart's going from the lower left to the upper right. Prices are consistently rising, and that trend remains intact. I wouldn't be surprised if we see something similar to the pullback, or maybe you could just call it a consolidation that we saw actually exactly a year ago today in the NASDAQ 100, where the NASDAQ 100 peaked around the 19th of July. It made a couple of lower highs, never saw a major downtrend, pulled back to its 200-day exponential moving average by October, and then resumed its longer-term uptrend. So a 2 to 3 month pullback, or maybe you'd call it a consolidation, is certainly something that we could see if this earnings season comes in weaker than expected. It looks like ultimately that pullback was around 10 or 11%. And I wouldn't be surprised if we see that just to give some time to correct rather than seeing a major price correction in the NASDAQ, because we are still seeing such strong earnings growth. And if you look at historical trends around election years, we do tend to see a late summer pullback until we get clarity on the election. And it almost doesn't matter whether Democrats or Republicans win. What the market is after is certainty. So once we know with a reasonable level of certitude which party is going to be in power, that's when investors start to feel comfortable putting their money back to work. Maybe we'll see tilts toward one type of policy that favors one sector over another. But the key thing is that we have that certainty. There's not that ambiguity, and that's when investors could feel better. So I wouldn't be surprised if we do get that late summer, early fall pullback, especially after about a 50% rally in 8 months in the NASDAQ 100. Just a truly massive index going up by 50% in 8 months is a tremendous move that I think could use some consolidation.